Happy day, everybody, and welcome back to Mortgage Talk and More with Mark Hairston. And of course, I'm your host, Mark Hairston. We are glad to be back in the studio, and I'm really excited to learn today from an old friend of mine named Earl Proger. When I say old, he's much younger than me, but we've known each other for a little bit. And he's in a world which I'm not that much familiar with, but I'm always trying to bring on some guests that are going to teach us something new. And I'm really curious about what Earl is up to these days. And I want to introduce him first and then talk about your experience and how you got in this space with these, what they call DSTs. You'll go into that some more. So,
That's right.
Yeah.
Hey, well, good to see you. It's always fun to get together with you.
Absolutely.
We have a history together in the mortgage industry, and that's where I have been for the last 10 years.
I want to say real up front, I'm very jealous of the hair, man. I mean, Earl's got the hair going on right now.
I think
Let's
this is
get
a
close up of that, Gavin.
I think this is a post DST experience. Anyway, it's pretty funny. There's a story behind that one.
I'm
actually.
sure.
Yes. But anyway, this is the longest hair I've ever had in my life.
I like
I'm
it.
Still trying to figure out what to do with it.
Yeah.
It's the cheap midlife crisis.
But we're not here to talk about that. But
Cool.
Anyway, tell us about Earl Proger.
Yeah, so I used to work for Apple. I've always been in sales, and around the end time of my tenure at Apple in education sales, I had kind of a funky experience with my mortgage, and I thought, man, I could bring technology, my knowledge, my sales. I could do this way better. And so I started selling mortgages. I got licensed and did that while at Apple in my spare time.
Okay. What year was that approximately?
Gosh, it was at least 10 years ago, somewhere around 2013.
Okay, got it.
Something like that. But I realized pretty quickly if I was going to be successful, I'd have to do it full time. So I got hired by a good company, CMG, a big company out of California, and I left Apple.
One of my competitors. Yeah.
Yes, exactly. And so I jumped out and did that and quickly bounced around, been through a few companies, and ended up at a very unique company called Angel Oak. And I was selling non-QM. And that's always been my thing, is to find an angle of something unique, something different to offer the marketplace.
Non-QM by definition is loans that are sort of outside the box.
Yeah, anything outside of government or conventional loans. Right. They're designated by definition non-QM, but things like bank statement loans, asset qualifiers, rent qualifiers, weird loans that are still great loans.
Sure.
Well, as you guys know, the market's really changed. And about 2 years ago, it was like someone just pulled the plug on my business, and I was down 90%.
I'm still feeling the pain.
Oh, so hurtful. Well, you've done really well, Mark. And it's very admirable. It's fun to see your numbers and see you succeed. But I made a decision at that point to start looking for other options and looking for some things. There's a quick funny story. I was literally at President's Club in St. Thomas with Angel Oak, and all the top performers.
A couple years ago or so?
Yeah, it was about a year and a half ago.
Okay.
And so we're out there having a great time. And on the second day, the president, he'd been late, came in and said, "Hey guys, come on into the conference room over here. Don't bring your spouses, just you guys." So we go in there, between hanging out by the pool and thinking, oh, we got new products, new direction, new adventure in this crazy time in the mortgage industry. Well, he took us in there to shoot us in the head and leave us for dead.
Leave us on the beach.
That's right. So we were all fired, and the company shut down its entire retail division and retrenched back to wholesale and correspondent only. So we were all without a job. Now I've since jumped to another company, but there's just no business for me. I've just been dead. So I have a friend in the wealth management world, and he reached out to me and said, "Look, man, I've found the most amazing product, been selling it for the last few years, but I'm so up to my eyeballs in wealth management for my clients.
Sure.
My nose is to the market, that I really want to bring someone in to laser focus, deal with this product and build it up for our company." So I had to go get licensed. That meant getting a Series 7, Series 63, SIE, all these different things so that I could sell investments to people.
Right.
And now I am in that world. So I'm deeply entrenched in that product.
Well, that's what we want to hear to talk about today, because, I don't know. I know I have some investments usually in we either own them outright. My wife and I, some properties, real estate I'm talking about, or we're in syndications with other people in some multifamily properties, or some limited partnerships as well.
Sure.
Now, I'm not in one of these DSTs, which stands for Delaware Statutory Trust. I've heard the term. I know very little about it. So tell us how that may fit into people's portfolio and how it's best used or leveraged.
Sure.
That's what I want to learn.
So it was kind of created about 20 years ago.
Okay.
And so the legislation, the Delaware structure, it's something that created an investment vehicle that is a tax-deferred vehicle. that would allow people to take their 1031 exchange money
Okay.
and put it into that for the tax deferred status. Now, you can also just go straight into a Delaware statutory trust. I'm not sure why you would when there's better options,
Okay.
but the main value of this is in a 1031 exchange.
All right.
So do we need to cover 1031 exchanges?
Well, I had an attorney on several months ago talking about 1031, and I'm
Mhm.
very familiar. I'm fairly familiar with those.
Mhm.
Okay, where you can take your capital gains and defer them through an investment very similar to what you've already sold, if you will, and to
That's
buy
right.
into real estate another type of property. And that's a great tool. So I'm not sure the distinction personally on the 1031 versus the DST, because
Yeah.
that's what I want to learn.
Yeah, so let me clarify. So what is wrong with the 1031? Now, you and I have been
I don't know.
in mortgage a long time,
Sure.
and so we work with realtors. Well, if you're an investor who owns something, it could be little, it could be just a rental property, or you own something huge like an apartment complex or a business complex, whatever.
Yeah, strip center,
Yeah.
whatever.
When you look to sell it, you're facing a huge capital gains tax, especially if you're a wealthier person that makes a lot of money. You're at those top tiers.
Which is 20%, you said?
So it's 20% capital gains tax plus a 3.8% recapture tax from the federal government.
Okay.
All this is based on your income, your tax bracket, et cetera. So it can be less than those numbers. But typically, the kind of qualified investors we're talking about, they are at the top tier.
Yeah.
Now, the good news is we're in Texas. If you were in a state that also has a state capital gains tax,
California.
yes, and they are the absolute worst. So in California, you have to add a future 13.3%.
Ooh,
So you're talking 38% as much
okay.
in
some of those
California for
states
the
like
same
that.
deal. Oh, yeah. And it's just, can you imagine taking millions of dollars of profit and then just giving away 30-40% of it?
Well, Gavin Newsom has to live pretty good, you know what I'm saying?
Somebody's got to pay for those floods.
For that haircut.
That haircut, yeah, that's right. You should see my guy.
Yeah.
So
You
anyway.
don't even have a guy.
So it's crazy. So the deal is the 1031 exchange is a break from the government, but it's very bounded. So you have 45 days to identify replacement properties.
The 1031, yeah.
That's right. So if you're going to sell your investment and you want to roll it into and protect those capital gains from taxes, you have to put it into like property. You also have to, this gets very complicated. You also have to maintain the same level of debt service. So if you're at 40% debt on the thing you're selling, when you roll it into new properties, you have to maintain a 40% debt ratio on the new stuff.
Okay.
Right? So there's all kinds of like versus like. So I think a lot of people don't go down the 1031 road because of the risk. I mean, think about it. If you're risking hundreds of thousands of dollars in taxes and you're unable to identify these properties in that 45-day window,
Yeah.
And you can't close
That's not
on
very
those,
much time either.
it is
45
not.
days. Let's
Now you
face
have
it.
180 days to close.
Right.
But the first 45 is when you identify. And beyond that, you're out.
Yeah.
If you don't close those properties.
That's the risk of those deals.
Right.
Sure.
And so it puts a lot of pressure on your sale price. It puts a lot of pressure on your purchase price of the new properties. And if anybody gets wind of the fact you're doing a 1031, they know they've got you over a barrel. So you lose a lot of your negotiable power, et cetera.
Mm-hmm.
So if you're a realtor, you know that you're going into a very stressful situation. You could lose your client's money in tax burden.
Mm-hmm.
And so everybody's stressed out. And so those 1031s can be really challenging, and it keeps people on the sidelines. It keeps people from selling because they're facing this burden, right?
Got it.
Here's where the DST is amazing. It's such a green field. Nobody knows about this. In fact, half the CPAs I talk about haven't heard about it either.
I had never heard about it.
Yeah.
I mean, I've heard the term, but that's about it.
So for the last 20 years, and it really peaked in 2008, literally there were hundreds of sponsors. And when the financial world collapsed, a lot of those went away.
A lot
and
of
then
what
it's been
went
building
away?
back up.
The DSTs?
The DSTs.
Okay.
So a lot of people stopped doing DST investments, and it dropped by, 80%.
Okay.
And then it's been climbing back up, and we're now starting to see a real resurgence of options again as a really great platform for investors.
Okay, so if somebody like myself has a rental property, we sell unless our capital gains are it's $500,000, and we say, well, we don't want to do the 1031, or possibly we don't want to kick our money out. We want to keep it working.
Right.
So I'd come to you and tell me how you would counsel me.
Right.
Okay. I'm a client. Okay. As we speak.
You bet. You bet. So first of all, you've got to take the entire proceeds of the sale.
Okay.
So if that 500,000, maybe it was a $1.2 million sale.
Okay.
So you got that money. Now you need to move that money, and your option in a 1031 is to identify one or more properties to roll into, right? But my option is the Delaware Statutory Trust. Now, the Delaware Statutory Trust is itself a real estate investment.
Okay.
But over here,
It's always real estate.
It's always some form of
Okay.
real estate.
Okay.
And there's a lot of classes, apartment complexes, office complexes, medical, self-storage. There's a lot of different categories. But what happens is the DST sponsor is what they're called, the investor. They have purchased something. So let's just say there's a big San Antonio apartment complex I went down and reviewed a couple of months ago.
All right.
So they have bought like a 450 unit apartment complex. They have some financing. They put their own money in it, and now they're selling shares in that investment. So you're moving from active property management of your own personal property. You're taking that money and putting it into one or more DSTs. And by the way, you can diversify by putting it in, let's say, 5, 6 different DSTs.
Okay.
Right? Across the country, across different asset classes.
But typically a DST will own one class of type of real estate.
That's correct.
Apartment complex, mini storage, warehouses, or whatever.
That's right.
Okay.
That's right. And the structure of the DST on their side.
It's not a REIT.
No, it is not a REIT. Now that's the difference. So a REIT is an investment trust. You put money in, and the shares go up and down. It's liquid, and they're able to buy and sell within the REIT and get rid of properties and bring in new properties.
Those are usually public companies. You buy stock on the exchange.
Absolutely, absolutely.
Yeah.
So with the DST, they're stuck in something that they are not allowed to refinance. They're not allowed to do anything with until they decide to sell.
Okay.
And then you get a piece of those profits as well. But the whole time it's cash flowing, all that money has to go back out to the investors. So you've taken your money and you've spread it across some DSTs. And so your money now is in a passive investment. So your role is nothing more than investor. The sponsor and their master lessor, the person who's leasing the property to from them, they're now generating income. Now, their idea is they're looking at something. They say, oh, the marketing's poor. There's minor tweaks we could make to the property. We see big changes in the surrounding environment that's going to make this place more valuable. We can increase rents.
Yeah.
That kind of thing. So they've chosen something because they see a big future.
Okay.
Right? So that thing's cash flowing. And typically you'll be getting 4 or 5% per year as income.
Okay.
So the first thing you've done in Texas is you sheltered 24% of your capital gains from taxation. So right off the bat, you just earned 24%.
Okay.
Congratulations.
Thank you very much.
Done.
Thank you.
The second thing that happens is, go ahead.
Going back to the timing, the 1031 45-day deal.
Yes.
What's the timing on this? Let's say I close today and I have $500,000 that I want to do something with.
We can literally place you in DSTs in a day or two.
I know, but is there a?
It's the same 45-day window.
Oh, it is. Okay.
Yeah. So you still have to decide whether you're going to put it in a DST.
Got it. I wasn't sure about the 45-day.
Yeah. And we'll get to why that's strategic.
Okay.
In a minute, because it's a great option.
But it gives you time to analyze them too.
Absolutely.
You have time to look at what the options are for you. So you're not like waking up one morning and saying, what am I going to do?
Yeah. And that's my job, is to say, what's your risk tolerance? What's your geographic decisions? What kind of properties do you believe in? And here are the stats. Like I've got one right here. That's the Moody Rainy Street Hotel down here in Austin. It's a DST.
Okay.
And it'll last about 10 years. And it will earn, they're projecting 4.5% to 6%. We'll see what they get. But the point is, so the second benefit.
It's a hotel?
It is a hotel.
Got it.
Yeah. So somebody else is paying a master lease to the DST sponsor.
Got it.
And that goes up. So what they do is they distribute the profits to all of the investors. So you are now an investor in DSTs, and every month you're going to get whatever that, profitability that they've been able to achieve is. 4 or 5% per year is typical.
Yeah.
And so you get monthly income. So not only have you saved initially on taxation, now that entire amount, not the minus taxes, the entire amount is earning 4 or 5% per year, and you're getting monthly distributions. And then down the road, when the market's right.
Can you defer those distributions to buy more shares or no?
No, because there's only a small period of enrollment when people can invest,
and
then they close.
It's cut off.
It's
done. A closed-end deal.
That's right.
Okay.
So you cannot open it back up for investors.
Got it.
It is closed.
Got it.
Again, another limitation of the laws around a Delaware statutory trust.
Yeah. So highly regulated.
Very regulated. Most of them are in a 10-year mortgage. Like they have a portion of it lent to, and it's 10 years interest only. But here's the thing, they're not allowed to refinance. So almost every one of them has a bounded window of 0 to 10 years, because at that 10 years, they have to have sold,
Okay.
right? But most of them close out in 5 to 7 years is very typical.
Okay. And how are you taxed on your distributions? You get a K-1 or a 1099, or do you know?
You get a 1099 and it's treated as regular income.
Okay. And there's no, typically in real estate, you'll have some tax benefits, as an example, because of appreciation. You don't have anything like that. I guess that'd be part of the overall.
Well, that's what's nice about it. It's a passive investment. So that's all on their side, right?
Mm-hmm.
Now let's move forward. Let's say 7 years from now, the market's perfect and they say sell, right? So they dump their asset. And let's say they sell it for typically about 50% more than they paid for it. Now that 50% bump, that gets distributed to everybody. So your shares just earned back what you paid initially, plus the step up in basis. And now you're getting that 50% bonus. Now, if that was 7 years, that's about 7% per year, plus you were earning, let's say 5%. So now your internal rate of return's about 12%, but that doesn't even take into account, the tax savings on the front end.
Right.
So it's actually a very strong, viable
sounds like it.
basis. Yeah. And at that point, you have a choice. You can either roll it into another DST, you can roll it into real estate. You've got all kinds of options. You can keep 1031ing every time these things mature. And that's a fun thing for me, because that means my clients will hopefully be repeat clients as they see their DSTs mature out.
Yeah. Is there any regulation in deals that I like to do? I like the principals to have an interest in it financially.
Oh, yeah.
Is that part of the rules? In other words, the principals being the management team.
Oh, yeah. The sponsor.
Are the sponsors, whatever I forget the name you call them.
So they're on the hook for the loan.
Okay.
And they usually carry a fairly significant part of the
deal
weight as well. So what they say is, like, here's one here, that Moody Rainey one. The total offering was about $88 million for that hotel.
Okay.
And
where is that, on Rainey Street?
That is on Rainey Street.
Oh,
yeah. Now in this particular case, I don't believe they even have a loan. But they, as of February 5th, they had already raised $73 million of that from DST investors, and they're expecting this thing to roll for about 10 years. So, of course, they'll find a good spot, they'll sell it.
Yeah. Well, Rainey Street is
Yeah.
probably a pretty good location.
Yeah.
Well, let's talk about some of the potential downfalls and every investment has a risk to it.
Absolutely.
So the risk is the market shifts, or
or the DST sponsor doesn't manage the property well and it doesn't earn profit. You know, or the market in that area, like let's say these apartments in Alamo Heights in San Antonio. What if that neighborhood goes to crap? You know, what if San Antonio experiences a real downturn in the economy and rents go down? Yeah. So there's always possibilities of market risk. And since they're in it for a longer period of time, you either have, pretty calculable increases. Like Austin, up until recently, we've only seen an uptick.
Yeah.
Even in 2008, we kind of went sideways and then kept going, right?
Yeah.
Recently, we've actually seen our first pullback in a long time. So that's a risk. The market could change.
Now, an example, so they could either raise money to develop something like a hotel, possibly, or they would buy something that's already existing. Is that correct?
Typically, they're only buying pre-existing.
Okay, they're not developing properties per se.
Let me give you a weird story. So in Houston, a DST is the Academy, the company Academy Sporting Goods.
Sure.
They have a large home office in Houston. And a few years ago, they realized that home office was something they were being taxed on. It was a real burden. So they sold it to a DST sponsor. So now the DST sponsor bought it and rents it out to Academy.
Okay.
But the cool thing is now Academy has a write-off. They can write off their rent.
Sure.
All that stuff. So for them, it made a lot more sense not to own their home office.
That's interesting.
Yeah. And so the DST sponsor owns it. They have a very set schedule of rents coming in from Academy. It's a very safe investment. And they're generating great income for their clients. And eventually they'll sell that property.
Yeah.
So it's going to be a very interesting turn there. Another one I know of is a sport team's facilities as well. That is also a DST. So
now you mentioned, before we got a few minutes left. Let's make sure that our audience knows how to get a hold of you. So tell us your number, however you want to be connected to.
Well, so I'm a part of Grace Capital Management right now. Okay. And we are beginning.
They're a local based group?
They are local. It's a wealth management firm. The principal's been doing this for 25 years.
Okay.
The firm has somewhere between $100 and $200 million under management. It's a small firm, only about 4 or 5 of us there. And I'm going to be the DST guy, but we're in the process of redoing the website and adding an entire DST website. So I'm there to build that business.
That's awesome.
Now, if they want to reach out to me directly, they can go to my email, which is Earl at grace-cap, C-A-P,
Okay.
.com. So
Got it.
Earl at grace-cap.com.
All right.
And that'd be a good way to get a hold of me.
Really, really, really good stuff, man. I've just learned. I always try to bring on guests that I can learn from too. So
Nice.
so here we are. So what are some of the misconceptions of, and maybe like you said, sometimes your CPAs don't even know about this, or
That's
your
right.
financial planners possibly don't
That's
know
right.
about this, much less the general public.
Yeah.
What do you think we really need to know, but besides the 1031 option?
Right.
Um,
So there's two things. First of all, it's typically older investors that are going to be excited about this, because a lot of people, they've been managing property for many years and they're just done.
Yeah.
They're not getting a lot out of it.
We're kind of done.
Yeah, there you go. So what you want to do is you want to sell it, but you don't want to pay the taxes.
That's right.
You also want to have something inheritable from your heirs.
That's right.
So this is going to be a primary, like estate planners, CPAs, for older folks to say, sell that stuff. Don't saddle your kids with active management that they fight over. Well, I want to keep it and keep bringing in money. I want to sell it. Well, yeah, how do they do it, right? So it leaves a mess for your heirs. Where instead, if you sell it, move all that into DSTs, a range of DSTs. Now, what are you giving to your heirs? Simply shares that can be divided evenly.
Yeah.
Now, what's also awesome is when you do pass away, you get that step up in basis on the DST value too. So you have permanently sheltered not only the original taxes, but also these, the step up in value that has happened by the time they receive their DST shares in an inheritance.
Okay.
And then when those mature, they have a choice. They can go buy real estate, buy more DSTs, take their money and pay the taxes that are on the now smaller step up in basis since their person died.
Yeah.
Right. So it's a wonderful way.
Who values the share price at that point? Let's say 5 or 6 years from now. How is that valued? Who does it?
Yeah, so it would have to do with probably the statement from the DST sponsor.
Okay.
Because they're going to be receiving income monthly. There's
That's
going
right.
to be a continuing on.
So the income can go up, obviously.
Oh, absolutely.
If rent rolls go up and you're buying an apartment complex or whatever, obviously that could go up.
Yeah.
Now, let's talk a little bit about accredited investors. You mentioned that there's a terminology called accredited.
That's right.
So let's share that with people, because it's not for everybody.
No, it's not. So first of all, an accredited investor, you can be accredited in multiple ways. If you're a single person, you have to have made $200,000 minimum per year the last 2 years, and it's reasonable to expect that you're going to do the same this year.
Okay.
Okay. For couples, that bumps to 300,000, right? And then the other qualifier, if you don't fit those, is that you have a $1 million net worth. And that can be in your real estate equity, cash, whatever.
Okay.
But it cannot include your primary home.
Okay.
So a lot of people have a lot of value in their primary home. We don't consider that for accreditation.
All right, got it.
Lastly, you can be accredited by being in the industry. So if you're Series 7 certified, whatever, that means you've gotten the education and proven your knowledge, because all of this is about risk taking. So if you go into alternative investments, things that require accreditation, you've got to know your stuff, and you might lose your money.
Sure.
So two things: you got to be able to lose your money without too much, devastation,
right,
and stress. And you got to know what you're getting into, so somebody's not pulling the wool over your eyes and selling you a bad investment.
Yeah.
So let me address that, may I? About the quality of the investment.
Absolutely.
So let me tell you why Grace Capital is like the cream of the cream, and why you want to work with us, and why I went to work for my friend.
Okay.
So when you're a wealth management firm, you have a broker dealer for all your basic stuff. In our case, it's Fidelity, the big gorilla, right?
Sure.
So all the stocks and funds and things that we move our clients into, they're all coming through Fidelity. So wonderful, we got that coverage. Now, for the alternative investments like DSTs, because Fidelity doesn't offer those, we had to choose a different broker dealer. A year ago, he moved himself to a broker dealer that happens to be the #1 DST seller in the country. The top guy in that company actually placed almost $400 million into DSTs last year.
Wow.
So big dog in the industry. But what that means is he's got the resources. So they have 5 analysts in this company. One of them has the top analyst position you can get, which would get you into a job at a hedge fund, for example.
Okay.
So the 5 of them, they evaluate every DST available in the marketplace.
Okay.
Every one of them. And
they don't offer them, they're just analysts?
Right. They analyze them, a dealer will offer to our clients.
I see. Got it.
So to be honest with you, about 75% of them don't make the cut.
Okay.
So we have the best of the best that have been vetted by a team of 5 analysts. So we're trying to take away as much risk, as much potential future harm from our clients when getting into a Delaware statutory trust. And that's very important. Nobody else has that kind of accolades. There are a lot of companies that are like, we offer all the DSTs.
Yeah.
Well, you might get into one where the sponsor has had a history of cooking the books a little bit,
Sure.
paying out from the excess account to make it look like it's earning more than it is.
Mhm.
They have ways of kind of fluffing things. And so you have to learn who is a reliable DST with a history
Mhm.
of great offerings that have, benefited their clients.
Yeah.
So we know all that, and that means we're only going to put you in the best of the best.
Well, that's fantastic. Yeah.
Yeah.
Yeah. So, let's see. We've only got about a minute or so left. What else can we cover that
Mhm.
maybe I've left out along the way?
Well, one thing I'd like to mention is it's a great strategy.
Mhm.
So obviously we come from the mortgage world, right?
Sure.
We have a lot of realtors, and
In my world, sort of in a box.
Yeah,
You
yeah.
know, I want to get outside that box. That's why
Yeah,
I'm talking to you.
Well, and you're in residential,
That's
neither
right.
one of us has been in commercial.
Right.
We can dabble in it or offload it, but commercial's a different world. But if you think about it, a realtor wants to get business. They want to get listings. That's the gold standard is,
Sure.
being a buyer's agent's fine, but being a seller's agent's awesome. So what you want to do is you want to have a way to make it safe. So even if someone wants to go into real estate, the DST is a safety net. So
Yeah.
whatever is left of the boot that they're unable to protect from capital gains taxes, they can throw into DSTs and protect that as
Okay.
well. So that frees up business.
I think that one of the bigger selling points too is this idea of management, to
Mhm.
become from an active manager of real estate to a passive,
That's right.
because managing real estate can be a real hassle sometimes,
Mhm.
with tenants or whatever.
Some people are done with it.
Yeah, we're still in the game, but it gets kind of tiring.
I got text messages from my tenant this morning. So.
Oh, did you?
Yeah.
Yeah. Well, I had a good friend of mine as a property manager on a couple of weeks ago, which is a nice alternative. But in the meantime, I think a passive strategy may even be better. So,
yes, that's right.
well, listen, we're going to wrap this thing up. I really appreciate it, Earl. It's always good
Yeah.
to see you and visit with you and learn something new.
You betcha.
And let's do some business.
Absolutely.
All right. All right.